welcome to Market Domination. I'm Julie Hyman, Madison Mills in for Josh Lipton today. Live from our New York City headquarters, we are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Incoming data, if it continues to come in a little bit hotter like recent data has, might make the Fed push more slowly on cuts next year, but we do think that there's a 25 basis point cut in the offing for a December meeting.
That he's really looking for a choice that checks all the boxes, and he hasn't necessarily arrived at a conclusion on who that might be yet. So I do think that what he's trying to do is he's trying to ensure that he's got someone who's going to be on board with his economic agenda, somebody who will be a calming force to markets, but also someone who understands what they're doing. And I think that a number of the people that have been mentioned for senior possibilities in this role are all people who I think would meet those qualifications.
We are looking forward to work with the new leadership. We think that policies that will accept crypto and help foster a better environment for the crypto industry in the US is important for the country. And hopefully companies like Robinhood that are used to work with regulators will be able to flourish under the new policies.
All right, we got 1 hour to go until the market close for the day, for the week. And let's take a look at the major averages, Maddie. 44,229. Still a little bit shy of a potential record here for the Dow, but pushing back in that direction, up more than 350 points today. The S&P 500 up about 1/4%. The Nasdaq up about 1/10%, continuing to sort of lag here. The S&P equal weight potentially set for a record today. There's been so much talk about the broadening of the rally. This is some evidence of that continued broadening.
I think it's really interesting that we're heading towards a week where we are going to eke out gains, despite the fact that we had that Nvidia report, which did not give that $300 billion swing to the upside that the options market was pricing in. We're still on track for a week of gains in the S&P 500 and, of course, on those other major averages as well. And it seems like, okay, maybe Nvidia doesn't have the chokehold that we thought it did, or at least the broadening story is helping prevent it from having that.
Right, the so-called Trump trade, trumping the Nvidia trade maybe to some extent. And it's not as though Nvidia is falling off a cliff, to be clear. It ended up turning around and being higher by day's end, but it didn't have the blowout energy, perhaps, that people wanted. You know what does have the blowout energy, perhaps, that people wanted? Bitcoin, which is getting ever closer to 100,000, still a little ways away from there, but it has also had a big week and really a big month, of course, since the election.
I mean, that's a huge run up. And it's been interesting seeing that run up in comparison with the run up you've seen in other names like MicroStrategy. I know you talk to Michael Saylor frequently for us, Julie, but it'll be fascinating to see, I think, what happens when it does hit that 100,000 level. Will we start to see a little bit of selling, and then will the buyers immediately come in and keep it up?
Yeah, Michael Novogratz earlier in the week of Galaxy Digital told us that he saw a washout coming at some point. He says maybe it's not until next year. We don't know what it's going to look like, what's going to trigger it, but usually in the history of Bitcoin, those cycles have happened and those washouts have come. We'll see what happens this time around.
And I think those cycles tend to be in 4-year increments as well. So is this the start of another 4-year run? Is it something else? It'll be exciting to keep covering those Bitcoin moves. But for more on the latest market moves and what investors should be watching moving forward, we want to welcome in David Wagner, Aptus Capital Advisors Portfolio Manager. David, it's great.
David already has the tree up.
I know. I was like,
I'm really impressed.
It looks beautiful, David.
Party in the spirit.
He's just skipping past Thanksgiving and going straight to Merry Christmas. I love it.
It's beautiful. I love the lights flickering in the back, David. Well, thanks for being here with us. I mean, tell me what you're celebrating heading into that Christmas holiday. It seems like the market is losing a little bit of its big momentum. What is going to be the next big thing to take us home into year end?
Yeah, Madison, I do think the path of least resistance is going to continue to be higher for the market. You're exactly correct. The market has seen a little bit of pullback over the past few days, but from a seasonality perspective, that tends to be normal towards the end of November. But in years when you have an election, much like what we saw in 2024, that rally, that Santa Claus rally, doesn't just continue to Christmas, it actually continues after Christmas. And Madison, Julia, I think that we have a lot of structural forces behind the market that's going to be continuing to push it higher. Whether you look at fiscal policy coming out of Washington, D.C., I'm a firm believer that Donald Trump is the nominal GDP growth candidate. Obviously, the Fed is going to remain pretty accommodative from not just a rates perspective, but I believe a balance sheet perspective moving forward in the future. Then in 2025, I do believe corporate tax rates are going to be cut to what Donald Trump has stated at 15%, which is going to give earnings of the S&P 500 another leg to move higher, especially after, I think we're going to continue to see strong revenue growth on the top line for a lot of the S&P 500 companies next year. So path of least resistance is higher for the intermediate term. Doesn't mean that we won't see much chop in 2025, but I remain bullish right now.
What are the things do you think, David, that could create that chop, though? What are sort of the obstacles you're looking for potentially on the horizon?
Well, there's a lot of overhangs heading into 2025. Obviously, we've had 2 great years of a bull rally. And I would say from a technical standpoint that when you do hit a 2-year anniversary of a bull market rally, the shortest duration of a bull market is 5 years. Albeit that 3rd year, which we are now in right now, tends to be the weakest of the 5 years. But just think what has to happen in Washington, D.C. in the calendar year of 2025. We're going to have individual tax aspects sunsetting from the 27 TCJA policy that Donald Trump put out just 6-7 years ago. We're going to have to attack that. We're going to have to attack a corporate tax policy. We're going to have to attack the debt ceiling crisis actually coming back into the picture on January 1st and January 2nd. We're going to have some flow through from the ACA with premiums potentially going higher. So I do think there's a lot of policies in Washington, D.C. that could create some type of emotional chop, though I do think that D.C. is going to actually try to navigate that turbulence pretty well because no matter what, the amount of liquidity coming in the market from a fiscal and monetary standpoint, it's really just not slowing down in the interim.
So if you continue to see that expansion globally, right, not just here in the States, at what point do you think we might see a little bit of an inflation problem coming into the picture here, particularly given some of the incoming administration's policies that could also potentially be inflationary?
Yeah, I think of the genesis of this question, focus is obviously going to be on tariffs. I do think in 2018 and 2019, we learned that the tariffs imposed by Trump and actually which current President Biden actually kept in place was not inflationary. I think the ramifications of inflationary are going to be coming back. They could happen if other countries impose more tariffs on ourselves. So I think that's what could create some more structurally higher inflation. Obviously, his immigration policies could do the same standpoint from a wage inflation standpoint. But I would say at the end of the day, I did just mention that Donald Trump is a nominal GDP growth candidate who's going to be taking office on January 20th. But he understands our debt situation. Obviously, we're at $36 trillion in debt. And Trump knows that there's really only 3 ways you can kind of get yourself out of the situation that we're in from the debt situation itself. It's to let your currency go to the wayside, which Trump, he's not going to let that happen. You can inflate yourself out of it, and you can grow yourself out of it. So I do think that obviously Donald Trump is going to, it's really hard to turn off the water spigot in Washington, D.C. when it comes to fiscal policy, and he understands that. But that's also going to come with some type of structurally higher inflation around that 3% level, in my opinion. But it doesn't worry me as long as our GDP growth is going to be growing at a faster pace than our deficit growth. And if that happens on a ratio perspective, on a deficit to GDP ratio perspective, we're going to start to see that come down. Obviously, the absolute number is going to continue to increase. But I think the best way to kind of fix the situation that we're talking about is going to be through growing out of this problem.
Yeah, we'll see if those policies can indeed achieve that. It's there's still some questions around how all of this is going to play out next year. Let's get to your strategy, David, because I think it's interesting. So many people have been coming on recently who have similar views to yours, but say buy small caps right now. You go in the other direction. You say you like large caps. Why?
I do. And I have to give a disclosure that I've been a small cap active ETF manager for almost 11 years now. So this is really hard for me to say. And I do believe that the structural forces behind large caps are going to continue into the future due to one reason. And it has all to do with the characteristic of operating leverage. All right, S&P 500 next year, you're expected to have 5% revenue growth on the top line. And that's equating to 15% earnings growth on the bottom line. That's the definition of operating leverage. The U.S. large caps are the only major asset class in the world, not just domestically, in the world that has that characteristics of operating leverage. Small caps, they don't have it. It's more of a service-based economy. If you look more internationally to IFA, that is also a service-based economy. If you go more towards the EM side of things, it's more commodity-based off of obviously energy and some tech value additive services. So as long as we continue to see momentum in the economy, most people would assume that's going to benefit the smaller capitalization companies and expand breadth, which I do think can happen. But right now, I would not be betting against large caps due to the characteristics of operating leverage.
So let's say you don't want to bet against large caps, but you do want to be diversified for the broadening narrative that folks keep referencing here across our shows. How would you kind of position yourself to be diversified for that growth into something like the S&P equal weight hitting that all-time high today, for example?
Yeah, I think a lot of people would answer your question, Madison, on where they should be invested from an asset allocation perspective. I want to barbell small caps and large caps, own quality, yada, yada. I actually disagree with that. I have a saying now that it's, in a world where everyone is looking for alpha, I think beta is underappreciated. And at the asset allocation level, I think if you can own as much beta as you possibly can, the S&P 500 exposure, with keeping risk in check through various different sundry forces of owning volatilities in asset class, long puts on the S&P 500, because I'm a firm believer that fixed income and bonds aren't going to give you the return stream that you've been accustomed to over the last 40 years. But not only that, they're not going to give you the correlation benefits you've been accustomed to over the last 40 years, that you have to rely and think differently in this new world. You have to be pragmatic over dogmatic by owning vols and asset class, which gives you the opportunity to own convexity, to own more beta. Because at the end of the day, I said, as much as it's fun and cool to look for alpha in this market, I think beta is underappreciated, and I just want to own as much beta as I possibly can.
All right, David, good to see you. Happy Thanksgiving and beyond.
Merry Christmas.
Have a good one.
Cheers, y'all.
Cheers. We're just getting started here on Market Domination. Coming up, Amazon announcing another multi-billion-dollar investment into OpenAI's biggest rival, Anthropic. We'll get you more details on what it means more broadly on the other side. Plus, shares of Nike higher following a bullish analyst note. We're checking in on some of the top calls of the day later in the hour. And at 3:30, it's the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into two stocks to help you make the best moves for your portfolio. Stick around, more Market Domination still to come. The AI trade showing not much sign of slowing down. Nvidia handily topping third quarter earnings estimates. That was a top headline this week, of course. Another headline emerging today, Amazon announcing another investment into Anthropic. That's OpenAI's biggest rival, to the tune of $4 billion. Joining us for more on the AI landscape is Corey Johnson, Chief Market Strategist at Epistrophe Capital Research. Thanks for being here, Corey.
I usually inhale before I say
Epistrophe
Capital Research, yes.
That's I will do that next
There we
time. So, when we have these various investments and the various sort of chess pieces being put in play, it leads me to wonder where we are and who has the upper hand.
I thought the Amazon Anthropic announcement was really interesting from a lot of accounts, but we really are at the building stage of AI. Sometimes I'm just so thrilled that I'm going to get to live in this age of AI. Well, information, the processing information, will be readily available at all times. It's just going to be a real life-changing thing, I think. But right now, we're in the building stage of that. And so the partnership with Anthropic and Amazon is so interesting to me from a semiconductor perspective, because Anthropic has promised to help develop the chip that Amazon's building, which they're calling wonderfully Trainium.
Tranium.
Because it's for training large language models.
The large cranium for your tranium.
Maybe, perhaps.
That was good.
It sounds like a Marvel superhero thing, right?
It really
something
does.
discovered. But what they've really done is they've although the processing power will be used in Amazon Web Services, what has really happened here is Amazon's bought themselves a customer, because now Anthropic has promised to use that chip, which they are going to spend billions to develop. Now they've just got a big customer for that chip, even though it's going to be sitting within the AWS centers.
I was trying to confirm this with them this morning, this idea that AWS is their primary partner for chips, but they really don't want to commit to the idea that they're only using Annapurna Labs as their chip supplier. When do you think people will start to be more comfortable saying, we're not going to use NVIDIA as much as we're using Trainium from Amazon?
So there's a couple things going on. One thing is, I've used a metaphor. You used to say in IT, you'd say, no one ever got fired for buying IBM. Now you actually might get fired for buying IBM. No one's getting fired for getting NVIDIA chips, right? So if you can get the NVIDIA chips, if you're Oracle and you want to build up data centers to compete with Microsoft and Amazon, you go get NVIDIA chips. Right, and so we see that happening here. I'm really curious about what the partners of NVIDIA are going to say to NVIDIA 3 years from now. Saying, hey, remember when you took your gross margins from 46% to 79%? And you made us pay all that when we couldn't go anywhere else? I mean, wonder if that's going to create any bad feelings among customers. I've certainly heard nothing. And I asked this question to a lot of the customers, the people buying these NVIDIA chips, the people putting in orders for Blackwell, and they're not mad about it. But they're spending billions to get those chips.
Well, and so that leads me back to the question that we've been asking now for a while, which is what are the alternatives and what is going to cause people to turn to alternatives? Because is it going to be cost? Is it that I don't really need that chip necessarily for my needs? It's too much car for me, to use another metaphor, right?
So we certainly see a lot of development. We've counted over 50 startups that have received, I think I figured, like over $3 billion in funding in the last year to create new semiconductor companies. One, Grok, has gotten a lot of attention, multi-billion-dollar private market cap right now. There's a company called Positron that I've invested in that is already shipping a product, and they've done it with a lot less money. They're doing it with chips that are going to cost a lot less money, and some of the performance standards are actually beating the Grace Hopper right now.
But are those chips on the market yet? Are customers buying them yet?
They're starting to. And I think that we're going to see more of that. AMD is starting to make some inroads. We see that from AMD and what they're telling us their sales have been. And that's one of the reasons that NVIDIA is rushing so hard. I mean, there was a lot of conversation on the conference call and afterwards about this is a Q4 event, calendar Q4. They're in their 2026 fiscal year already. But they've already shipped, I think, 15,000 Blackwell systems. So they're out there in the marketplace. All their main customers have them. So tick off their main customers, right? You've got Microsoft, certainly. We've also got Amazon. We've also got Facebook, Meta, and now we've got Oracle. Also, they don't name it in the financial filings or in their conference call, but a new one showed up in their 10Q showing a new customer that's over 10% revenue, and we think that's Oracle. Full disclosure, another stock that I own.
Gotcha.
Well then, so if you put aside kind of those big hyperscalers, is there an investment opportunity in playing how smaller companies, that still big but not Oracle level, are going to invest and purchase chips?
100%. There are so many companies that are benefiting that. We're going to hear from Dell next week. There are a lot of companies, I've been spending a lot of work on the networking companies that are helping move the data within an AI center. Companies like Applied Optoelectronics, Coherent, Fabrinet. These are probably not names that roll off your tongue. They don't even roll off my tongue. And I two of those three, I have all of those stocks I've owned at different times. But those are companies that come from the telecom world, but they're doing data interconnect, and it's kind of amazing that these things that used to be done for long-haul optical networks are now being used to move information from the bottom of a stack to the top of a stack, literally at light speed. There are these devices called VCSELs, vertical cell emitting lasers, which are lasers that sort of sit inside of a pocket of a chip that shoot information straight up in a laser to move the information just within a data center. Really incredible inventions that are leading to billions of dollars in ancillary revenues while the build out of these data centers is happening.
And is money going into those names? I mean, there's so much that has flowed into Nvidia because that's the one that.
Yeah.
And to be frank, like not only do the names not trip off the tongue, it's hard to understand this stuff. It's hard for people to wrap their.
It's really complex.
Nvidia on a high level, people can kind of understand that, right? There's chips that power data centers that are going to, power AI. But then when you start talking about lasers that shoot things up and, wires, which are not necessarily sexy, right? That's not, maybe that's not capturing retail imagination.
It's not even going to be. It already is. Just like the internet, there are all of these companies that are making the guts of these machines, and the stocks are flying. I mean, AOI, again, I'm talking my book because I own the stock, but if you look at the stock chart, it's just straight up and to the right. It's actually not straight up to the right. It's been up and down and up again. And you see that with Coherent, you see that with Fabrinet, you see a lot of companies out there, CoreWeave, Dell, really benefiting from the build out of these data centers. And I think it's really, I'm not going to, I really am going to, if I hear someone say early innings again, I'm going to barf. I'm just going to do that because I'm sick of it. But
we're past the early innings, or are we in
no, it is early days though.
Early days.
But I just really, there's every reason to believe that this is just starting, because what's going to happen next, right, is you're going to get compute on the edge. You're going to have AI happening in the phones, right? The software hasn't caught up to where the Apple iPhone is right now, which is kind of an amazing thing. It's really more about permissions, but you're going to have that. You're going to have it in laptops, and you're going to have it in automobiles. Nvidia talked about auto sales. Our auto sales were way up this quarter, where sales to Lucid and others. It's going to be really exciting times.
Cool. Well, we'll talk to you again.
Fun time to be a tech analyst, I'll tell you.
Definitely. Yeah. Fun time to talk to one, too. Thanks, Corey.
Thank you.
Appreciate it. Thank you. Now time for some of today's top analyst calls. First up, a look at Flutter, the parent company of FanDuel, being initiated at Goldman Sachs with a buy rate. And Goldman says it sees upside to Flutter's 2027 guidance here. The shares, by the way, are at a record high here in U.S. trading today, up more than 2.5%. They're up more than 50% this year. Goldman Sachs says, in particular, that the street is still underestimating U.S. revenue growth. They say U.S. revenue will be growing at a 20% compound annual growth rate. EBITDA is going to more than triple, specifically in the U.S., from this year through 2027.
Which is huge.
Yeah.
It's huge. And it's also another catalyst that they talk about here is that there could be a re-rating opportunity where they're included in some of the major U.S. indices for traders moving forward. So not only is there a fundamental growth story, there's also a kind of, I guess, a popularization as an investment vehicle for U.S. investors story here. That EBITDA forecast tripling by 2027 really stood out to me. They also talk about how they still have dominant positions in online sports betting and gaming, and that they have an ability to acquire customers that is more efficient than peers in the space, and that because they've maybe been ignored by major averages traditionally here, the valuation is not a problem for them as well, which I thought was interesting to note given the run-up we've already seen.
Yeah, definitely. Yeah. They say still buy there.
Still buy there. All right, well, let's turn to retail. Nike shares getting a lift as Needham initiates coverage on this stock with a buy rating. Needham citing the CEO change at the helm as a much-needed move in the right direction. And Julie, I thought this was fascinating because it's amazing to me how something that doesn't necessarily mean anything fundamentally yet can lead to a lift in a stock. We haven't seen a huge change yet from the new CEO. It reminds me of what we're seeing with the Trump trade. We haven't gotten the policy yet, but we're trading on the story to come to get ahead of it.
Right. Well, and Nikic in his notes here says it'll take time to rebuild the fundamentals. The analyst here, by the way, Tom Nikic, was at Wedbush, now is at Needham, so he's initiating his coverage on Nike and a host of other shoe companies, but Nike in particular stood out to us, and the shares are reacting today. He says with the leadership of Elliott Hill at the company, it will take time to rebuild the fundamentals, but he says the numbers have come down enough to account for the weakness the company's seen. And this was amazing to me. He said, if you go back 3 years and looked ahead to the full year 2025 earnings estimate, he said it was $6.60. So 3 years ago, Nike analysts were looking ahead and saying it's going to be $6.60. Right now, that earnings per share forecast from analysts is $2.75. So it has come down a lot from the initial optimism, and that illustrates really the changing fortunes for Nike over the past few years. But he says, okay, that's low enough now. The stock is all priced it in. Now there's time for upside.
Time for upside, given that, to your point, he also believes in that management. He says they're, quote, clear-headed about the mistakes they've made and working aggressively to correct them. And there's a compelling earnings recovery story there as well.
Yes, we'll see how it plays out. And also, AbbVie, those shares getting an upgrade at Leerink Partners to outperform from market perform. The firm citing an opportunity for investors to buy these shares after a big pullback that we've seen recently. Now, the shares fell 13%. I believe it was November 11th or so. And that's after the company came out with the results of a couple of drugs to treat schizophrenia that failed to meet their goal. And so the stock tumbled a lot. But the analyst over there, David Rissinger at Leerink, says that this was an opportunity because of the sell-off for investors to step in.
Right. This quote in here sticks out. That we think the stock reflects low expectations for the company's pipeline and for future external deals. And I think it'll be interesting to see how stocks like this also perform amid the incoming administration. I took a look at the Invesco ETF for pharmaceuticals that includes AbbVie. It's up about 13% year to date. So measly compared to the S&P 500 year to date. But perhaps there is an anticipation of growth to come under an incoming administration that maybe is going to be more favorable to pharma.
We shall see. I don't know. It kind of depends on who gets in there, I guess. But he also, there's a drug they make that treats psoriasis and also just recently got approval for ulcerative colitis. And he likes the prospects for that particular drug, both in the U.S. but also outside of the U.S.
Right. Potential growth stories both here and elsewhere. All right. Well, coming up, it is the latest edition of our series, Goodbye or Goodbye. We're taking a deeper dive into 2 stocks to help you make the best moves for your portfolio. Stick around. Much more market domination still to come.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, we're taking a look at attractive and cautious cyclical names within the mid-cap space. I'm here with Joshua Wine. He's Hennessy Fund's portfolio manager. And let's get to the stock that you like here, first of all. It is Brinker International. EAT, appropriately enough, is the ticker. Owner of Chili's, Grill and Bar, Maggiano's, Little Italy. The stock has had a pretty monster run over the past year, up some 180% and trading near a record. So let's get to why you like it here. You say it's a strong operator of those various chains. Tell us kind of how you look at that.
Yeah, it is. So certainly in the last few years and prospectively as well, growing, margins, operating margins and net margins. So we like to see that. Certainly, the restaurant space right now is challenged, food inflation and muted customer demand, but they're continuing to operate the way that, that they're known to. We hear a lot about TGI Fridays and Denny's and other operators that are having a real hard time of it. So it's good to see that, it's kind of business as usual at Brinker. And
it's interesting because there is sort of this value proposition for diners, right? Maybe if they're trading down to something like this.
Exactly.
That is working for them too, potentially. So you talked a little bit about the margins, free cash flow generation, which I know is also something that you look for in your investments.
Sure. I mean, it's certainly, certainly a company can be growing and profitable and maybe not generating free cash flow. So there's some debt on the balance sheet, and it's certainly more than manageable, because of the free cash flow generation. What we're looking for primarily with a name like this, it's in our Hennessy Cornerstone Midcap 30 fund. We're looking at earnings growth, valuation, and stock price momentum. And so first and foremost, we just put the name in the portfolio in the last month or so, and it exhibits all three of those qualities.
So let's get to the valuation one, because given that we've seen that big run, you don't automatically think, oh, the stock looks cheap right now. So how are you valuing it, and is it because the earnings have also been growing?
Sure. Yeah. The stock's gone on a big run, and I think it's surprising to many. It's been, the sentiment is so poor in this space. What we're looking at with valuation is price to sales. So it does tend to be a very restrictive criteria. It brings in names like Brinker very often, kind of low margin, restaurant and consumer discretionary names, and also some industrials, which we can talk about. But yeah, it's not maybe as cheap as it might have been a few months ago. It's gone on this big run. What we're looking for with stock price momentum is to not to be the first one to the party. We want some confirmation, I suppose, that it's a good party, and so people have caught on. We don't want to catch a falling knife. We don't want to, sit on dead money for too long. So, we'd rather buy a little bit late than to sit on something for, early and for a long time.
Right, and I've heard a lot of people talk about the fact that momentum has been sort of the thing that has worked very well this year so far. So let's talk about the risks here potentially, and it's sort of the macro factors that could weigh on casual dining, I guess.
Right, yeah, I think the big factor that got us to this place where a lot of restaurants are struggling is food inflation. It's been tough. I mean, people talk about McDonald's all the time for the reason that it's not what it used to be in terms of price point. So, and the same goes for a Brinker or an Applebee's or anyone. So I think if food inflation could stall somewhat, it would give time for the average person's earnings to kind of catch up. So I don't see food deflation coming anytime soon, but certainly we could maybe have some time for people's wallets to catch up to the reality of eating out now.
Yeah, well, so we'll keep an eye on this one. The stock that you do not like as much is Oshkosh. Now, this stock has kind of gone sideways this year.
Yeah.
It is not the maker of overalls, but the maker of machinery.
That's right.
And so Oshkosh, let's talk about why this one you don't like as much. We just talked about momentum. Right. This one, obviously, the momentum is not in the positive direction.
Yeah, I mean, the fundamentals of the name are great. They're doing very well, and great cash flow generation and all of that. This name was in our midcap 30 portfolio until recently, and it would have remained in the portfolio if not for the stock price momentum. So earnings growth and valuation were there, and it was really about the stock price. So I think investors are taking a look at the name and similar names, and they're taking pause, whether it's because of the economy or their defense business, which maybe.
Okay, well, let's get to those points, because fears over a slowing economy, something that is so cyclical, like an Oshkosh, sort of dependent on industrial growth.
Right.
Is that sort of where those fears are centered?
Yeah, I mean, a lot of their customers are municipalities buying fire trucks, which they make, or ambulances, or an industrial company buying a forklift. So, they are certainly at the center of what's going on with capital spending. And certainly anytime there's fears over a slowing economy, these names will take it on the chin, at least for a moment.
I wonder that now that you say that, is there also a concern that this sort of federal government level desire to cut spending is going to trickle down to those more local levels?
That's been the fear, and I think it's a very real fear, just in the sense that the stock price action in the last week or so for defense contractors has been quite dramatic. And so, I think that is an idea.
Right.
It might not make sense, but yeah.
Yeah, so their defense business, you talked about fire trucks and things like that from municipalities. What does their defense business look like, and what could be potentially under threat there?
Yeah, I mean, they're making, kind of specialty vehicles that enable, rocket launchers and transporting troops and all of that kind of frontline type equipment. And when we talk about spending cuts in the federal government, a lot of that, can lead to the military, and it's kind of the most visible to the average person. And right or wrong, I think that is something that's being looked at, and other things as well. But certainly people, kind of, no pun intended, shoot first and ask questions later.
Right.
And, we'll see.
Yeah, and in this administration, which has also taken a sort of less wants less engagement on the geopolitical stage, potentially as well. So let's talk about what could go right for Oshkosh, and that's, could reignite maybe because it's been battered down.
Right. Yeah, I mean, I think people are coming to grips with what may or may not happen in the next administration. For us at Hennessy, it would be about stock price momentum in terms of bringing that back into the portfolio. We would need to see continued earnings growth and valuation. Those are right now in place, so it would really be about momentum.
Gotcha.
The 3 and 6 month price momentum have not been there. So.
And as you said, Brinker is in the Hennessy Cornerstone Midcap 30 Fund, and you guys recently took Oshkosh out.
We did.
Okay, Josh, thank you so much.
Thank you,
Appreciate
Julie.
it. And thank you for watching Goodbye. We'll be bringing you new episodes at 3:30 p.m. Eastern.
It's now time for some of today's trending tickers. You can scan the QR code below on your screen to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. Taking a look at Honeywell shares rising today, up over 1% here. The company striking a deal to sell its personal protective equipment business, PPE. Haven't said those 3 letters since that COVID-19 pandemic, of course, but it's not just the face masks that we think of. It's also got respiratory protection products, hearing aids, work boots, things that you could see in a manufacturing facility, for example. That all-cash deal of $1.3 billion went out to a PE firm. This is right after we heard about Elliott taking that activist stake in the company a couple of weeks ago. So one of the questions I had here, Julie, is whether or not this is going to be a move that is indicative of the company making moves to satiate their activist investors, or if this is kind of a drop in the bucket in terms of changes they're looking for.
I mean, they'd already also announced their plan to spin off their advanced materials business. So there is sort of a remaking, if you will, of Honeywell to some extent, but they've also been buying stuff over the past year as well. Carriers, security unit, air product and chemicals, LNG, tech and equipment business. So they've been adding, they've been subtracting. Yeah. So we'll see if they end up, sort of coming together with Elliott and figuring out some more moves to do. But these things seem to have been in the works pre-Elliott. So we'll see what happens.
It's a big company. They got a lot of
big diversified company, indeed.
Yeah.
And next comes the mover that I've been looking forward to discussing all day long, because today I learned that there is a publicly traded mortuary-related company, Matthews International. Those shares surging, the company beating fourth quarter earnings estimates, and indeed, this is a maker of caskets, memorials, and cremation equipment. It's a small cap company, a market cap of just under $1 billion, but bigger today because the company's shares are surging. Earnings coming in better than estimated. Now, sales did fall 7% year over year, but beat estimates. We also saw earnings per share fall, but beating estimates here. And the company has been working on some different projects, but overall, they said they're cautious. They're projecting adjusted EBITDA of $205 million to $250 million for fiscal 2025. But still, looks like people are liking the numbers today.
Looks like people are liking the numbers today. It's interesting following, they've had a tough year to date so far. So I believe it was down over 34% year to date prior to today's pop, which is certainly a massive pop here, moving 24% to the upside, the biggest one-day move for the company ever. I think that debt reduction was something that was exciting for investors to see. They liked the handling of their balance sheet. Liam Burke also noting over at B. Riley that their sales reflected a post-COVID normalization of mortality rates. So that's always good news.
Not something that
Good
you talk
news.
about, that we talk about very frequently, but I just thought it
Yes.
was a fascinating one.
Yeah, it
to
definitely is.
Get on today.
Really interesting. Well, also interesting, Thanksgiving is less than a week away, and it's going to be a record-breaking travel weekend. 72% of Americans plan to travel by car for Thanksgiving. That's according to Gas Buddy. Also, some good news for those drivers. Gasoline prices at their lowest level since 2021. Millions of Americans getting ready to hit the road for the holidays. Our next guest saying travelers can enjoy gas prices below $3 in more than half of states across the country. Patrick DeHaan, Gas Buddy head of petroleum analysis, joins us here with more. Patrick, great to speak with you here. Talk to me about that less than $3 a gallon for drivers. What can we attribute that to?
Well, certainly great optic ahead of Thanksgiving. What we can attribute it to, really continued corrections in the U.S. economy, the slowdown that has really stifled some of the economic growth. The Fed having raised interest rates really has slowed things down enough. Energy is one of those components of CPI that's really slowed down. And it's really a drop in gasoline demand as we head into the fall that is bringing the benefit of lower gas prices just in time for Thanksgiving. In fact, I just glanced down here now, 31 states where average gas prices are below that $3 a gallon mark. The national average, we anticipate, probably will fall below $3 a gallon just in time for Thanksgiving. We're at about $3.03 today. We're trending a little bit lower. If we hit that milestone, it'll be the first time since 2021. This Thanksgiving is going to be the cheapest Thanksgiving since 2020. Of course, back then, many Americans were staying home because of the pandemic. This recipe of low prices and a slowdown in inflation is likely behind the big jump in the amount of Americans that want to hit the road.
Yeah, it's pretty remarkable, Patrick. So does that mean then, if everybody's hitting the road, that the lower gas prices won't last?
Well, the irony there is that while many Americans, millions of us are driving, a lot of that driving is going to be focused on very limited windows. Wednesday afternoon, a lot of Americans, 60% of them driving between 1 and 6 hours, and all of those Americans then heading back Sunday. But keep in mind, school and work being closed on Thursday, on Friday. A lot of Americans stay very close to where they go for the entirety of the weekend, and that limits gasoline demand significantly on those 3 days. So all in all, you look at Thanksgiving and you'd say, oh my goodness, it's going to be a huge increase in demand. But typically the week of Thanksgiving actually sees lower gasoline demand than a non-holiday week. Again, that's because a lot of us stop our grinds of school and work to go celebrate the holiday.
Well, Patrick, you tell me, I thought 72% of Americans planning to travel by car. That seemed on the higher side to me, which made me wonder if that was some sort of economic indicator, people being more willing to drive versus flying because they might save a little bit, especially with these low gas prices. But you tell me, what's that look like in the context of other Thanksgiving holidays?
Well, you look at years past. In 2019, 65% of respondents said they were going to drive, and you showed that graphic earlier of our study. So this year, even higher, 72%. I think there's a lot of optimism now with some of the lowest Thanksgiving prices. Like, a lot of folks have been nostalgic for those sub $3 prices, and now 90,000 stations across the U.S. are there. I think there's a lot of optimism that inflation is slowed. There's been coverage that even what you're putting on the table at Thanksgiving has inched down just slightly from last year. But the biggest part of that psyche, $3 or sub $3 prices. Everywhere Americans driving, many Americans are seeing those sub $3 gallon prices, and that gives them a lot of optimism on making a decision to travel for the holidays.
Patrick, how long are prices going to stay below $3 a gallon?
I think most Americans that are seeing those prices, they'll probably remain within the arm shot of those sub $3 prices, probably through Valentine's Day. Now, there are some issues in the Middle East. The U.S. recently approving long-range missiles potentially being used against Russia. That could push oil up. In fact, oil prices are back above $70. So some of the tensions could cause the bottom to come in a little earlier, but I think most Americans are probably going to see some of these seasonal lows persistent through maybe mid-February.
All right, Patrick, we got to leave it there. Thank you so much for joining us this afternoon. Patrick DeHaan with Gas Buddy. Coming up on the latest episode of Financial Freestyle with Ross Mack, Web3 Media President Chris Lyon. He sits down with Mack to break down the differences between iterations of the web. Take a listen.
Where you could actually read things on the internet, right? And then the next component was the write era. So you have read and write. That's what we call like the Web 2. And then you saw companies like Facebook and Pinterest and Airbnb and like so many different businesses in the 2010 era. The big difference between what was going on in quote unquote Web 2 versus where we are now with what blockchain technologies can really encourage is this ownership layer.
Bank stocks are rising today with the KBW index hitting its highest point since February 2022. Our next guest says the potential impact of a so-called red wave still dominating investor conversations, with many expecting the new administration to adopt a more pro-growth, less regulation agenda. Joining us now, Jason Goldberg, senior equity analyst at Barclays, who covers this industry and is out with a note on this very topic today. Hey, Jason, good to see you.
Good to see you.
So you list quite a few different elements that could come into play with this incoming administration that could affect the banking industry. I'm going to ask you to start with the one that you think is the most important of all those potential things that could change in the next 4 years.
Yeah, I mean, if you think about what the administration's been talking about, it's a very pro-growth, less regulation type backdrop, and not just less regulation for the financial services industry and the banks in particular, which have been saddled with increased regulation over the last several years, but more broadly than that. So we do think, loan growth has been fairly subdued over the last year or so, when we think corporates have been kind of stuck on the sidelines. So I think more clarity on the economic outlook and an administration that's kind of investing in growth should allow loan growth to pick up. In addition, capital markets activity has been subdued. You've seen a slowdown in M&A activity, not a lot of equity issuance, and we think has the ability to move that higher as well.
So I'm going to parrot Julie's question then, because there are so many potential catalysts that you just mentioned, Jason. What do you think is the most important one that you need to see sort of regulatory clarity on, regulation clarity on, as we get into the incoming administration here, in order to continue to see this rally in financials?
Yeah, there's a lot of focus on capital. So last year, the Federal Reserve and other regulators came out with what's called the Basel III Endgame proposal, which basically increased banks' capital requirements about 20% for the largest banks. They did kind of water that down to 10% earlier this year. But if you think back to the Trump first administration, they were talking about a capital neutral plan. And I think, for the industry as a whole, getting something closer to that would certainly be quite beneficial. I think it would allow banks to lend more and also return more capital to shareholders in the form of additional buybacks.
Jason, I guess when it comes to regulation, as with so many things, you're always fighting the last war, right? So Basel III was a reaction to the financial crisis and an attempt to try to prevent that from happening again. What do you think the risks are from really, pulling back on some of those requirements?
Yeah, I don't think there's so much in the way of risk. I think the industry, coming out of the 2008 financial crisis, is on so much firmer ground today, right? There's all sorts of rules and regulations around capital, around liquidity, around long-term debt requirements. There's increased supervision and the like. So there is kind of a risk to overdoing it. And I think over the last few years, you've kind of seen regulators kind of maybe turn the dial too much. And I think under the next administration, you could see that pendulum maybe swim back, just a little bit.
I wonder too, Jason, how you think about that pendulum swing alone as sort of a headwind. The idea that executives are having to rush to adjust to the whims of Washington, while you still have in the background, by the way, the central bank cutting after the biggest run up in interest rates in decades here. What do you make of that kind of messiness?
Yeah, no, so there's certainly a lot of uncertainties. And if you think about what, some of the policies are, whether it's, immigration reform or tariffs, that does have the ability to potentially be inflationary, which could cause the Fed maybe to act, differently than would have otherwise. So, you've seen rates come down a little bit. The curve is a little bit steeper, which could be beneficial over time. And that's certainly something we'll have to keep an eye on, as the end of this year into next year progresses.
Jason, do you think that the regulatory regime and policy regime we're going to see over the next year will benefit some banks over others, large versus regional, or do you think it's going to be something that sort of helps the entire industry?
Yeah, I think there's a bias towards the bigger banks. They've certainly seen the biggest onslaught of new regulation. So from a capital standpoint, I think the biggest banks have to benefit. The super regionals will likely benefit from maybe not as stringent increases in things like liquidity and debt requirements. And then really for the small mid-sized banks, we haven't seen a lot of consolidation in the banking industry, right? It's slowed over the last several years. And we do think, with I think 4,539 banks in this country, we just don't need that many. And so we do think once we get some clarity in terms of what the regulators' expectations are for merger requirements, we do think we could see a pickup in activity there.
That reminds me of an editor that quizzed me once on how many U.S. banks there were, and I missed the answer. I was
You should have phoned your friend here, Jason.
I was off to the downside by a couple hundred. It really is a lot of banks. I am curious, beyond kind of what you mentioned in terms of activity on the M&A side of things, you mentioned IPO activity as well. Is this going to be the exit year in your view? Are we finally going to have some good IPOs to cover?
Yeah, I mean, if you look at kind of like third quarter IPO issuance, I think it was like 50% of kind of the 10-year average. So we do think, and maybe not so much in the fourth quarter because we don't have that much time left, but certainly as we think about 2025, All the bankers we talked to say there's been a significant increase in deal pipelines, kind of even prior to the election, but even after the election, you've seen just a lot of dialogue around companies looking to tap the capital markets. The markets are an all-time high, and then you kind of get some, expectations of more growth opportunities and companies just not having to access to the markets over the last few years. We do think you'll see a significant pickup in activity next year.
Jason, we've been talking so much about regulation and fiscal policy. We haven't talked at all about monetary policy, which is kind of shocking. What do you think? There's a real question right now about what's going to happen with interest rates, whether they're going to continue to move lower, certainly move lower as much as we had previously thought. What does that mean for the banks here? Because, of course, there are upsides and downsides from rates going in either direction.
Yeah, no, certainly. I think, for the banks, generally speaking, it's not so much, if the Fed's going up or down. They like it when the Fed's moving at a measured, predictable pace. And when the Fed moves kind of quicker than expected or cuts faster than expected, then things get a bit rocky. And you certainly saw that latter part of 2022 into the earlier parts of 2023 when they moved, I think, faster than people, would have thought initially. So, we'll see, where they go, 25 in December or not, and what the path is next year. But one thing you've seen is, for the last several years, banks have been operating with a inverted yield curve. We got a little bit of positive slopeness to that. Hopefully we'll get some more steepness to the curve, and that should benefit net interest income. But when you think about net interest income for the banks, the biggest driver is typically loan growth, and that's been fairly subdued over the last 4 to 6 quarters amid one of them uncertainty of the election, which we got some clarity on, but other just kind of uncertainty in terms of which way, the economy is going. It feels like, the odds of a soft landing are increased. And that coupled with, the Fed's cut 75 basis points, a little bit lower interest rates, we do think could spark borrowing, into the latter part of this year and certainly into 2025.
Jason, great to get your perspective on all of this. Have a great weekend.
Thank you. You too.
Thanks. While we're wrapping up today's market domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. There's the closing bell on Wall Street, and now it's market domination overtime. I think I see a race car at the Nasdaq. That's fun. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with where the major averages ended on the day and on the week. The Dow at a new record close, it looks like here today, 44,296, up about 426 points on the day, almost a full percent as we saw a little bit of a push into the close there. And as Maddie pointed out earlier, positive on the week, almost 2% for the Dow. As for the S&P 500, positive by about 1 2/3 on the week. And on the session, seeing a little bit of a lift of about 1/3 of 1%. The Nasdaq, the laggard of the session, up not even 0.2. As for the week here, up about 1.7%. Now, elsewhere, the things we've been watching, we've been talking about the S&P equal weights also outperforming on the week and closing at a record today, as well as we continue to see that broadening. Should mention Nvidia, although it did end up rising yesterday following its earnings report, it actually fell in today's session by about 3%. So that's something to keep an eye on. And the Russell 2000 as well. We've heard so many folks express optimism and enthusiasm for small caps. The Russell 2000 up 4% on the week. So also showing a lot of strength there. Finally, got to go back to Bitcoin here, see what we're seeing there as we continue to be on 100,000 watch. Not quite there, but as we pointed out, it has been a big surge and a big week for Bitcoin. Jared's got a broader look and deeper look at today's action. Hey, Jared.
What a tease this Bitcoin is. Fortunately, Bitcoin never sleeps. We got the entire weekend to wear our Bitcoin 100,000 hats. I do want to draw attention to the US dollar index, and specifically the dollar just broadly has been heading higher. This is the 5-day chart. 1% in 1 week, 1.2% is a lot. And I'm just going to show this real quick, but here's the 3-year chart. It is now broken above to 3-year, or basically 2-year highs. So that's something I will definitely be watching next week. But in the meantime, let's see what happened in sector land today. Consumer discretionary, industrials, financials all closed up over 1% today. And those are all cyclical sectors. And that was something that we were kind of expecting coming in to the election and afterwards, that there would be a wave of spending that would just be unleashed. And this could be some front running of it. There's also some tariff things in there, some immigration front running. All of that combines. And the net effect is that cyclicals are leading today. Let's check in on the 5-day price action. Materials and then utilities. Utilities is an interesting one. Energy, real estate, industrial staples. I think the takeaway here is everything is in the green for the week. Even healthcare, which had some pretty bad days, was up 1.6%, and it was the only one that was underperforming the S&P 500. Now let's check out our leaders. And here we have Bitcoin in the lead, GBTC up 8%. Only cannabis in China were in the red this week. So just another solid week after kind of dipping and slumping last week.
All right, Jared Blickery, thank you as always. Really appreciate it. The market's closing the week higher with the Dow closing just above those record levels. A quieter day for the bond market, though. The yield on the 10-year edging down just 2 basis points as investors weighing a mixed batch of economic data. Joining us now to put it all in perspective, we've got Christian Hoffman. He is Thornburg Investment Management's head of fixed income and portfolio manager. It's great to have you on, Christian. So help put a button on it for me. We had a little bit of weakness in consumer sentiment data this morning, a little bit of a surprise to the upside on services data coming out from PMI. Where are you getting clarity on what we can expect heading into that key December Fed meeting and what they should be doing then?
Honestly, I don't think we're going to get data that particularly moves the market either way. And frankly, there's not a ton on the calendar. It's a relatively quiet economic calendar. You know, certainly we're going to be watching the jobs number in early December. I think the data overall should put the Fed on hold. The market is pricing roughly a 50% chance of hold or a cut. And I think it's actually becoming increasingly political. I think there's a strong reason to believe that they will cut as a political posture. That's controversial to say and not particularly popular. But I think you saw the change in tone and posture between the press conference, which was largely focused on the emphasis that the Fed is not a political organization, and the following week where Powell seemed to be wanting to change his optionality and saying maybe we're going to hold here. So if you don't cut, I think it could be viewed as a political move. The Fed hates to do anything like that. So I think he might cut to appear to not be political.
Okay, Christian, tease this out for us a little bit more. Why would not cutting be seen as a political move? And does the data actually support not cutting?
I think the data absolutely supports not cutting. Frankly, we've gone from a Fed that went out of its way to suggest that it was data dependent, but everything we've seen since the summer suggests the opposite. You didn't need to do a huge 50 basis point cut in September. Arguably, you would have done 25 bips the month before, and really we should be on hold at this point. To your question, though, I think it could be viewed as there's certainly a history and an antagonistic relationship between Powell and Trump. So it could be seen that by not cutting, that Powell is trying to create some tension and some economic headwinds for the incoming Trump administration to deal with. Also, since you've been cutting right before the election and then changing your posture, again, it could all kind of become clouded and mixed up with that, unfortunately.
I guess I wonder, what is the evidence, Christian, to support the idea that they're going to cut to be political? Because they explained that 50 basis point cut. They said that it was because of that jobs print that they didn't have right before they chose not to cut at that first summer meeting. So I'm confused about where you're getting that evidence from.
I think the evidence is really going the other way. So it's the lack of evidence, right? That you're seeing economic data that is largely strong. And outside of the US, you're certainly seeing pockets of weakness. But look, you're flirting with a stock market at or through all-time highs. Broadly, you look at anecdotal and high-frequency evidence. Things feel pretty good out there. It doesn't feel like we're in the midst of a slowdown. So if we were worried about a slowdown, in September, look, things feel better now than they did then. And we've cut, through that period of time. So again, it seems like there's not any data dependence to force the Fed's hand at this point. And I don't know why you wouldn't wait and see how some of these things play out.
So if bond yields have been going higher, even when the outlook was for the Fed to keep cutting, if you don't think the Fed's going to be cutting as much, what does that mean for the 10-year and where we're going here?
Yeah, and I think for folks that aren't staring at screens all day long, this can be confusing.
Yeah.
I think there's a perception that the Fed controls all interest rates, but without yield curve control, which is something we've never seen in this country. Really, they just control short-term rates. So I think broadly, some folks might have expected, when the Fed starts cutting, interest rates will go down. I can get a more affordable mortgage. But again, at this point, they're really only controlling the short-term rates in the front part of the curve. So the fact that rates are notably higher, for further durations than 10 years are, again, maybe surprising to some folks. But again, I think a steepening curve into this point in the cycle. And really the driver of long-term rates has been much more fiscal, as we've approached this election cycle where we've had two parties that neither one has expressed much interest in fiscal conservatism and discipline. And that's why we've seen really the long end sell off, particularly as we see, a lot of potential issuance continuing to come from the Treasury.
Christian, I want to end with something you sent over in your notes that stood out to me. You said that you were recently in Asia and you were able to talk with folks about how they're thinking about the incoming administration's policy when it comes to tariffs specifically. Talk me through what you heard and I guess what surprised you in those conversations.
So a lot of times you travel abroad and you get commentary that's like, you crazy Americans, what are you doing there? We have I think a political system that is amazing. And largely unprecedented in the world, but it can cause confusion, I think, for some of our counterparties abroad. But this is one thing that resonated abroad that's also resonated here, and it's the lack of worry around trade and tariffs. So for those of us investing from 2016 to 2020, you will remember that there was really a 12 to 24-month period where trade and tariff fears were the number one factor and driver of volatility across markets, and really creating a number of actual winners and losers. So the rhetoric around this has not changed. What's interesting is that the market broadly seems to be pricing a lot of potential positive outcomes from this incoming administration without having a lot of fear or trepidation, of some of the negative baggage that, came from the previous term. I thought folks in Asia, particularly as they thought about trade with the U.S. and trade globally, would be more attuned to that and frankly more concerned. But they shared a lot of the optimism, that we see here in the U.S., I think particularly around hope of ending some geopolitical conflict. So that surprised me. And again, I hope everything works out well. But as investors, I think we always have to be positioned and worried about the downside. And I think that's something the market is probably not paying enough attention to at this point.
And we can always count on bond strategists and investors to have their eyes very firmly on the possible risks out there, as they should. Christian, thank you so much. Good to see you.
Thank you.
Coming up, we're taking a look at how the energy sector is set to be affected by another Donald Trump presidency. Stick around, more market domination overtime coming up.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator.
Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
We're taking a look at the energy sector with investment shifting away from renewables and back toward oil and gas as the U.S. braces for another Trump presidency. Our next guest sees tailwinds for energy company GE Vernova in particular as a result of Trump's pick for energy secretary. For more, we're bringing in Jed Dorsheimer, William Blair Group, head of energy and sustainability research sector. Jed, it's good to see you here. So there has been a lot of, sort of talk about what this next presidency is going to mean for a host of different sectors, but energy has been squarely in people's attention. GE Vernova keeps coming up, I have to say, with folks we've been talking to as a favorite pick. What is it about that company that makes it well poised right now?
Well, so first off, energy should be one of the most important. It's really the foundational bedrock in terms of everything else that's built on top, including the economy, including foreign policy. So, it is really critical, and Chris Wright is, a fantastic pick. In terms of GE Vernova, they're the world's leader from a market share. So when you look at league tables, they sell more natural gas turbines, which in this country makes 40% of all of our electricity. So critical in terms of, just being able to operate things. And then they also make a lot of the switchgear at the substations that actually condition that electricity so they can then flow out on the grid. So they are literally critical in the energy sector. And I think that's probably why a lot of people like ourselves, like it, and it's really been performing quite well.
So how does an incoming president who is Mr. Drill Baby Drill going to impact a name like GE Vernova?
Well, think about it. In terms of drilling, one of your byproducts is going to be natural gas that you're going to be getting out of those wells. And so we have a surplus of gas right now at ultra low prices. And that means that your input fuel is going to be very favorable for the products that GE Vernova makes. And on top of that, when you look at the data center demand for AI, which is really skyrocketed, it's unprecedented levels. I mean, going all the way back prior to 1976 to even get anything that looks close to the load growth that we're seeing today. That requires 24/7 dispatchable energy, which renewables just does not provide. And so, quite frankly, we published a study that was controversial and contrarian this summer. We found that the variability from renewables is actually contributing to the problem, not solving that, which, we saw the benefits of GE Vernova and the profitability coming from this company well before the Trump transition, Trump's win ever occurred.
Jed, to go down a little bit of a left turn with that, how much does sort of battery technology solve for that issue, and is that another area that people should be looking for investment?
Oh, 100%. I mean, batteries solve the renewable problem. So by misunderstanding how renewables will act within our existing system, which means that you get a benefit 0 to 5% adding solar into your grid. But over 10%, the actual generation asset is subsumed by the variability or the interconnection costs that are pushed onto the grid. Now, batteries, because the sun doesn't shine 24/7, are going to give an operator the ability to monetize those electrons and store it so that you can shift that in terms of time duration. And so I think it helps, and it increases a utilization from 10% to 60%, for example, by adding 4 hours of battery storage. It still doesn't solve all of the problems, though. And I think what you're going to see is probably a mix of generation and different infrastructure to try and tackle the energy issues that we're seeing today.
What do you think is going to be the most significant change with regard to energy policy from this administration, Jed? Is it going to be more drilling permits? Is it going to be a pullback in support for the renewable energy industries? What is it going to look like?
Well, I think so just to provide some context, we have seen a grid with load growth of about 2 to 3%, which is roughly about since over the past 40 years, resulting in about $2 trillion of invested capital. And if we look at what we're seeing today, we should have invested at least double that. So you're going to see a flow of capital into this sector that we have never seen before. Now, it's debatable whether or not all of these plans for data centers will actually go through, or whether or not some of those will will not make it through. But generally, we have a level of demand that's unprecedented. So I think it's a call to action for all technologies to, and I think what you will probably see is renewables that don't fare well unless we're going to actually change how our system operates. Now, one of the things that's not directly energy related, but I'm curious to see how it plays, is both Elon Musk and Vivek Ramaswamy, and see how they are going to, what they're going to do with this Department of Government Efficiency. And that could have a big impact on energy. Is one of the the major blocking factors on nuclear energy has been the Nuclear Regulatory Commission. So I think it'll be interesting to see how all of this plays out.
It certainly will be, especially when it comes to some of that regulation in the incoming administration. Jed, thank you so much for joining us this
Thanks for having me. Have a great
Appreciate it.
weekend.
Have a great weekend. Thank you so much. Well, Republicans suddenly warming to the U.S. economy while Democrats have become gloomy. The economy itself hasn't changed that much in recent weeks, but of course, something else has. There was that presidential election. Joining us now to discuss, we've got Yahoo Finance's own Rick Newman. Rick, love to have you here.
Hi, guys.
On a Friday afternoon, and I got you in the morning, too. So I know you've been looking at a lot of the data, the exit polling, to get an indication of how consumers are feeling and then comparing that to the consumer sentiment data. What's going on? How are the vibes?
I knew this was coming. This is actually from the University of Michigan's consumer sentiment data. And, you know, we have seen this phenomenon before where people rate the economy based on whether the political party that they favor is in power or out of power. So, for example, leading up to the election, we saw Democrats thinking the economy was in better shape than Republicans. And now, just in November, the latest reading came out today, we've seen a complete flip in this. So Republicans in 1 month, from October to November, suddenly much more optimistic about the economy and also about the future of the economy. And Democrats exactly the opposite, much gloomier about the economy and also about the future of the economy. So, I mean, it's obviously because Republican Donald Trump won the White House. And Republicans, they swept. They have control of Congress now. So people project their view of political parties onto their read of the economy, and this just seems to be really important because one of the recurring themes of the Biden administration has been they just could not get a majority of people to believe that inflation was really going away for good, that job growth was as strong as it was. And we're also seeing exit polls that show, yes, inflation and the economy are the reason Kamala Harris lost. That was the biggest issue that worked against her. So just interesting. I mean, everything has become politicized, including what people think about the economy.
Well, and is that effect strongest right around the election? In other words, does that correlation between party in power and people's view on the economy and their party affiliation, does that fade like a year in?
I think it persists.
Yeah.
So I have not seen any actual detailed, rigorous studies of this effect, though they might be out there or they might be on the way. But the University of Michigan first noticed this in 2016, and they did not ask people they do the survey every month, but every month they did not ask people what their party affiliation is. So there were gaps in the party affiliation part of it, and they noticed between October of 2016, and then I think the next time they might have asked was April or March of May of the following year, this huge shift between Republicans and Democrats. And that seems to be the first time that this really showed up in a meaningful way. So the shifts seem to happen when there's a change in power,
right,
which would be around elections, but then they do persist. And we definitely saw Republicans much more concerned about the economy than Democrats during the Biden presidency, but now it's going to flip the other way. So it looks like Democrats now are going to be saying everything stinks while Trump is president. By the way, they also measure independents who are consistently gloomy. So the independents didn't really change very much between October and November, and they were actually gloomier than either of the partisan groups, interestingly.
I have no evidence. This is anecdotal. It's just a question. Is there part of it where Democrats are thinking, okay, well, maybe the economy was worse than I thought because The majority of the country voted for Donald Trump, so maybe I missed it.
I think it's anecdotal for all of us, Maddie, honestly. We're all trying to figure this out. I think, so what's different from 20 years ago? I mean, for sure, people are doing a lot more doom scrolling on social media. Everybody now has whatever you want to get angry about. There's a cable TV news channel specifically for you. If you're a liberal, you can be outraged about Trump all day long. If you're a conservative, you can be outraged about Biden all day long. So it seems that we just have this. There's just a melding of how people think about the economy and how people think of the rest of life in America, especially political life. So, your view of the economy is based on whether you like the people running the country. Yeah. And I would point out, there was no big change in the economy from October to November. I mean, it's been pretty steady state, very marginal changes. Nothing different in, inflation is getting back to normal. It ticks up a little, it ticks down a little bit.
But it's
no
more
real
about
changes.
where people think it's going, maybe.
Well, that's another, and inflation expectations. But all these things have been improving. Slowly. We've seen slow, very incremental improvements in consumer confidence overall. And by the way, the overall sentiment index didn't change very much from October to November, but the way people believe by political party just completely flipped.
Amazing.
Yeah.
All right. Thanks, Rick.
See you guys.
Appreciate it.
Thank you.
Time now for what to watch next week. Starting off on the economy, personal consumption expenditures, also known as PCE, that's coming out on Wednesday. Economists forecast the Fed's preferred inflation gauge will hold steady in October, with total PCE at 0.2%, core PCE at 0.3%.
And moving over to the earnings front, a big week for retail. We've got Macy's, Abercrombie & Fitch, and Nordstrom all reporting next week. Macy's announcing results for the third quarter on Tuesday. Analysts saying the retail giant could miss sales estimates. Investors will listen closely to any commentary on the company's holiday outlook as we approach a critical shopping season from consumers.
And as for the Federal Reserve, it's releasing minutes for November's FOMC meeting. The Fed cut interest rates by 25 basis points in November. The minutes will give us more insight into each Fed official's stance on monetary policy and give us then more insight into what the next move could be in December. That'll do it for today's Market Domination Overtime, but don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money.
But first, it's been a wild week for markets as investors reacted to the highly anticipated earnings from Nvidia. Here's a look at what you might have missed from the past few days.
Nvidia's third quarter results just out here hitting the wire and the company beating estimates.
Nvidia is just a beast. They just have huge advantages over competition.
We're in the middle of an AI transformation, a huge disruption. It's gravy from here.
Across every single number, it was a win.
Bitcoin's always been the gateway drug for the digital asset space. There are individual people in every country of the world that participate in Bitcoin.
Anybody who gets out of Bitcoin right now is making a mistake.
Ultimately, it's up to the client in terms of how they want to utilize crypto in their portfolio.
A slew of retail earnings also on tap this week. We've got Walmart, Target.
Customers have always come to Walmart looking for value, but now they're coming to us looking for convenience as well.
At the end of the day, you need to deliver. We saw that from Walmart, and we didn't see that from Target.
Gross profit margin for Target down. The bottom line is this: Target's in the penalty box.
Hello and welcome to Asking for a Trend. I'm Julie Hyman in for Josh Lipton today. And for the next half hour, we're breaking down the trends of today that will move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we'll be diving into. Record day on Wall Street, the Dow closing at a new all-time high, and Bitcoin flirting with the $100,000 level. We're breaking down the takeaways of the trading day straight ahead. Plus, counting down to the holiday shopping season, people are expected to spend more, but is it because they're feeling better or is it inflation? We'll take a closer look. And the battle over return to office, plus the implications for the commercial real estate sector, what to expect heading into 2025, coming right up. As co-heads of the soon-to-be-formed Department of Government Efficiency, Elon Musk and Vivek Ramaswamy want federal employees in the office 5 days a week, doing away with remote work. That move follows that of other organizations like Amazon and the Washington Post, both owned by Jeff Bezos. So what will the 2025 return to office push look like, and what effect could the Fed's rate cuts or lack thereof have on the commercial real estate market? Joining us now, Richard Barkham, CBRE Global Chief Economist, Global Head of Research, and Head of Americas Research. Thank you so much for being here, Richard. So there's a lot to sift through there. But let's just, first of all, give us a high-level take on where we are right now in terms of the commercial real estate market compared to the pandemic period. How far back how much progress have we made?
Well, I think we're at the start of a new cycle in commercial real estate. And remember, commercial real estate is not just offices, it's industrial, retail, it's apartments, and it's data centers as well. We've had a big value drop in commercial real estate and a rise in vacancies, particularly in the office sector. But I think as we move into 2025 with economic growth being fairly robust, I think we're at the start of a new real estate cycle.
And where is that growth going to come from? As you pointed out, commercial isn't just office. Where is the demand going to come from?
Well, let's start with the hottest sector, which is data centers. We've talked about artificial intelligence and cloud computing. That's setting up huge demand for data center facilities. And we've got a very high level of development. We've got rental growth, and we've got that sector really on fire at the moment. But if we look at apartments, people will have heard that we've got oversupply of apartments, and maybe we do in certain markets. But we've also got very high levels of absorption. People are going out and renting apartments, forming households, and absorbing a lot of that space. So those vacancy rates are going to come down, and people don't rent apartments if they're worried about the economy. Retail is doing very well on the back of good consumer growth and really revitalized and effective retailers. And we've got the lowest sector vacancy rates in retail. And then if we get to the office sector, well, that's where the big problems in real estate have been. We've had vacancy go from 12% to 20% very quickly. As a company, we're doing broadly the same amount of leases as we did in 2019. But up until now, companies have been taking about 70% of the space that they previously did as they digest and react to a new pattern of working. But I think even there that the emerging trend is good. We've seen a big upturn in leasing in Manhattan. And Manhattan isn't the totality of US office real estate. But it's quite often the market that leads. So I think it's a question of companies getting more confident. A bit of a balance emerging in the workplace about the balance between remote working and being in the office.
Right.
Companies are recognizing that the amount of really high quality space is actually relatively limited. So I think we're beginning to see a bit of an upturn in the office sector.
Let's just pick up on that last point. We were looking at some of the key card data that's compiled by Castle, which looks at how often people are coming into the office. That number hasn't budged a lot. So even if the vacancy rate is going down, are we seeing, for example, companies, take out leases on smaller spaces or different kinds of spaces? Because it would seem like to really see a significant increase in leasing, you would have to see more people coming back to the office, no?
Well, I mean, you've got to remember that Castle don't cover the whole market. They're a great company, but many big office owners self-perform that security. So, there may well be patches of the market where you've got more occupancy than that data suggests. I mean, for instance, if you take Manhattan, which I've already mentioned, subway ridership is almost back to where it was prior to the pandemic. So, but don't get me wrong. I think we're still in a world of hybrid work,
right?
And we're never going to go back exactly to where we were prior to COVID, where on balance we spent 4.5 days in the office. We're now closer to 3.25 days in the office, but I think we will trend up from here. There are certain sectors of the market, for instance, the tech sector, which is, moved completely remote, I think, for a period. I think we'll see some movement from the tech sector, particularly as the excitement and the product development around AI gathers pace. I think we'll begin to see the tech sector coming back into the office. So I think the pendulum will swing a little bit further back towards being in the office. Although, we're not going back to where we were pre-pandemic.
And Richard, finally, just quickly, I want to get your take on rates also, because, expectations around where interest rates are going seem to be changing. Is that going to be less of a tailwind for the commercial real estate sector than you had thought maybe six months ago?
I mean, I think everybody's reevaluated the trajectory for interest rates, and perhaps they're in general going to stay higher for longer. But we do see interest rates continuing to gently move down over the next 12 months. And that will be a tailwind for real estate, both because it gives corporates who occupy real estate more confidence, but it also gives investors more confidence to invest. I think it remains, even though we've adjusted perhaps, and not, the terminal value of the Fed funds, not 3.25, but 3.75, it's still lower than it is today. And that will be a headwind for the sector in 2025.
Richard, thanks so much. Have a good weekend.
Thank you.
Wall Street posting strong weekly gains with the Dow notching a record close. Yahoo Finance's Jared Blickery joins us now with the trading day takeaways. Hi, Jared.
Hi, Julie. Stocks are back this week after they slumped last week. So let's take a look at what we got going on. Stocks soar and the Dixie roars. That would be the DXY, excuse me, or the US dollar index. And we'll get to that in a second. First, I want to show the bullish index in the sectors, all of which were green this week. Even healthcare, which has had a lot of problems recently, up 1.6%. There in the upper left, you see that cyclical sector, materials, XLB. Then we have utilities, real estate, energy, then real estate. Interesting mix of cyclicals and also interest rate sensitive sectors. But what I've been looking at, and we've been talking about this each morning and afternoon, it seems like, is the 10-year T-note yield in the dollar. So the T-note yield since the election, in fact, it started this rise before then. It's just off very low, very slightly under those recent highs. And now I'm going to show you a chart of the dollar, and you're going to see it's a very similar chart here, but we've risen above these highs over there. So the dollar is just ripping higher. It's at two-year highs, and sometimes this spills over into risk markets. And I think we're starting to get into that territory where it could be causing a problem here. So that's something we have to manage and worry about next week. But obviously, it was not a bearish factor this week.
No, and is it going to be a bearish factor, I guess, going into next year? We're starting to get all of the outlooks for 2025.
I can't wait. 2025 targets, and we still got 2 months here, or 6 weeks. This brings me to my second point, which is 3 times the charm for stock returns. The last 2 years, we have had it looks like we're going to have double-digit returns. So B of A, Michael Hartnett's team is out with an analysis this week saying that we can expect double-digit returns next year as well. This is something that's only happened a few times in history. It was 1927 and 1928. 1929 is kind of ominous because that was that peak there ushered in the Great Depression. Then there was 35 and 36. 37 was terrible. That was still the Great Depression, by the way. That was a long depression. 54 and 55 didn't happen, but it did happen 3 years in a row in 95, 96, and 97. And that's where Hartnett is saying that we are this year. However, there is a big but, though. Rates have to participate. Rates have to be on the right side. So he doesn't want to see the 30-year above 4.5%, and it's just a little bit below that right now. He doesn't want to see the 2-year greater than 4.5%, and he doesn't want to see real rates that's adjusted for inflation more than 2.5%. So I'm just going to show you the 30-year rate here because I'm curious as well. 4.6%. So he does not want to see that over 5%. But if it stays under 5, double-digit returns next year. So should be easy, right?
Well, we'll see about that. Okay, and then we can't let the week go without talking about crypto.
Yes. Why are we farming crypto instead of mining it? Well, I sat down with Julius de Kempener, along with Sydney Freed, one of our producers and my co-host of Stocks in Translation, and we talked about crypto and some of the uses that you might have for it. Here, let's take a listen.
So I moved all that money into Ripple, and that then again kind of doubled. And then, so they were sitting there, and you know, as we discussed before we started, I live on a farm, and just you don't want to know how much equipment a farmer needs. And so we bought a wheel loader, which is a super expensive piece of equipment, but you know, so the
I
wheel
love
loader,
that your farm is financed with your crypto profits.
And I got a friend in London who is big in Bitcoin, and I told him the story, and he loved it, and I said I'm going to spray paint the logo of Cardano and Ripple on both sides of the machine.
Did you do that?
No, not yet.
Yeah, he didn't do it. To all the people that say crypto doesn't pay for things, it does. It has uses.
But he didn't pay for those things in Cardano and
That's
Ripple.
right.
He had to put them into dollars or whatever,
Yes.
you know,
You
an
had to make a
actual
conversion.
currency that people accept.
Also, it's a very bad lesson for people. Just put all your money in crypto and buy your wheel loaders and farm equipment with it. You know, I think he got lucky, and the message for me was he took profits when they were just staring him in the face instead of hodling it. He took his profits. So.
But, you know, better that than a Lamborghini, in my opinion.
A wheel loader is much more fun to drive.
And
maybe.
more useful, I would think, as well. Jared, thank you so much.
Thank you.
Appreciate it. Stay tuned. We've got more asking for a trend on the other side. With the weight of elevated interest rates and inflation, consumers are looking to take advantage of deals. A record number of shoppers expected over the Thanksgiving holiday weekend. That's according to the National Retail Federation. Black Friday remaining the most popular day to shop, with 2/3 of shoppers expected to buy in stores. Catherine Cullen, National Retail Federation Vice President of Industry and Consumer Insights, joining us now to talk more about this. So, Catherine, first of all, talk us through your predictions for this coming weekend. And what we're going to see sort of driving people into the stores. Is it going to be deals?
Absolutely. Well, as you noted, we are expecting record turnout this holiday season for the Thanksgiving weekend, which we know is no longer the kickoff to the season that it used to be, but is certainly the halfway point. Shoppers over 183 million, about 18 million more than we saw before the pandemic, headed out to shop both in stores and online all weekend long. As you noted, Black Friday is the most popular day, and shoppers say that this weekend remains popular for them because not only do they associate it with great deals, but it's also about tradition. It's about the social activity. It's about getting out there with friends and family, celebrating a little bit more of the holidays, maybe burning off a little bit of the big meal the day before.
What are you seeing in terms of the discounting cadence this year versus last year?
We know that retailers have really adjusted their promotion strategy for the holidays in response to consumer demand. Started before the pandemic, but really picked up in 2021 when, due to supply chain challenges, consumers were kicking off their holiday shopping early. As a result, retailers have rolled out promotions earlier than they used to. Certainly many deals starting in October, pre-Black Friday deals, preview deals, really starting in November, several weeks before the Thanksgiving holiday. What I am noticing that's a little different possibly this year is we're seeing more of these sales rather than being framed as Black Friday, way before Black Friday occurs. We're seeing them as preview events. So still very much building towards the Thanksgiving weekend with the understanding that a lot of shoppers are looking to that weekend. They have time to shop. They have motivation to shop because there's only a few weeks left between Thanksgiving and Christmas to end the holiday season and do all their shopping.
I know that overall for the holiday season, the NRF is looking at holiday spending to rise 2.5% to 3.5%. So that's as much as $989 billion. How much of that is, sort of spending on more stuff versus the effects of inflation year over year?
It's a great question. Obviously, inflation is top of everyone's mind. It's played a big role in the consumer psyche and the national conversation. We do know that when it comes to our holiday forecast, we do account for several factors, including inflation, as well as weather and other drivers of consumer demand. When we look at this year, it's important to note that while inflation ticked up in the latest reports, most of the inflation that we've continued to see really is focused on the services sector, where goods, in many cases, have seen much lower inflation rates, if not disinflation, compared to where they were last year. So we are expecting to see real growth in terms of holiday sales and real growth in terms of units consumers are buying. This matches up with what consumers told us themselves. They said they're budgeting about $902 on average, specifically for gifts and other seasonal items, with much of that being focused on that gifting category. And in fact, they're spending a little bit more on family this year than they did last year.
Interesting. When we look again, going back to the deals, is there a day that is sort of the peak deal day from retailers?
Certainly everyone wants to know what's the best day to shop and save money. We really see this vary across specific retailers and specific brands. We do know, of course, that Black Friday is the most popular day to shop, both online and in stores. It has surpassed Cyber Monday in terms of online popularity. And retailers, of course, are responding to where consumers are looking to shop and when they're looking to shop. I would expect we'll see great deals, of course, leading up to the week, as well as on that specific day, just knowing that that is one of the biggest days to shop, and it also is one of the biggest days for men and for younger consumers to go out and start their holiday shopping.
Catherine, thanks so much. Appreciate it.
Thanks so much.
Stick around. We're asking for a trend on the other side. For our chart of the day, we got to look at investment opportunities with consistent growth and comparing them. Yahoo Finance's Madison Mills back now with a closer look at this. Hey, Maddie.
Hey, Julie. So taking a look at an investment vehicle that's pretty run-of-the-mill, I guess I would say. We're taking a look at the S&P 500 year-to-date here. It's up a little over 30% year-to-date. I want to compare that to the MSCI World Index ex the United States. So that's this blue line here. You can really see U.S. equities kind of maintaining that U.S. exceptionalism narrative when you look at how much U.S. equities are outpacing global. And then, of course, you've got the corporate bond market, the underperformer, eking out a little over 3% of gains on the year. The reason I wanted to point this out today is because earlier in the day when I was on our morning show, we talked a lot about the data coming out of Europe being weak and what that meant in terms of fiscal expansion globally and whether or not that would be enough for other nations to see some of the gains in their equity markets that we've seen here in the States. And people were saying not so much, right? Really park your money in the S&P 500. We're going to continue to see flows from other countries worldwide to the United States when it comes to the S&P 500. So that's going to be a potential catalyst for the S&P moving forward as we see those flows getting sucked out of Europe and put into U.S. equities. Another potential catalyst here for the S&P 500 is going to be that continued growth when we think about, of course, the AI rally moving forward. That Nvidia of it all is going to continue to power this index, but having your money in the S&P continues to allow just a little bit of a diversification outside of tech, outside of the Nasdaq. But earlier today, I spoke with Chad Morganlander from Washington Crossing Advisors about investment opportunities, and this is what he had to say.
The reality is it's concentrated market cap weighted index. And let me tell you, guys, I lived through the 90s, and a lot of these companies, they may be wonderful companies, but the rate of change when they grow from 50% down to 35%, there's a rapid readjustment of valuations. Buyer beware on that point. So we're recommending that investors buy high quality stocks that are very consistent and growing. You can make a lot of money that way, and also be mindful about the leverage that they're taking on. So you want to buy companies that are growing, profitable, well capitalized, but don't over gamble and over allocate towards a lot of the winners. You want to start trimming those back a bit.
So Chad, they're arguing to still focus on stock picking, but as you can see on this chart behind me, if you focus on the S&P over the last year, you would have certainly made a lot of money, Julie.
Yes, you would. Madison, thank you so much. Appreciate it. That's a wrap on today's Asking for a Trend. Be sure to come back Monday at 4:30 p.m. Eastern for all the latest market-moving stories affecting your wallet. Have a great night and a great weekend.